Mr. Druckenmiller, thank you for your time.
Pleasure to be here.
Tomorrow we have the last Fed decision for 2017. I guess they're expected to raise interest rates again. What's your expectation of what comes out of this event?
Well, I think they're going to raise rates a quarter, but I don't think that's news to anybody or anybody in your audience. So that's my expectation.
It's the second to last meeting under Janet Yellen, and they're going to now be led by Jerome Powell into next year. The market thinks they're going to raise 3, 4, maybe 5 times. Does that mean normalization is underway?
I hope so, but I don't know. You're talking about humans who I'm not that familiar with, and events could change over time. But it's interesting you ask about normalization, because the conversation I hear in the media and in the financial press seems to center around tightening. And I think the conversation should be what you just alluded to, normalization. And the difference being, normalization means sort of reestablishing a hurdle rate for investment that's been with us actually for probably 5,000 years. It's just in this 8-year period we've decided to throw that out the window. And it's a little bizarre when you listen to the reasoning. Jim Grant had a piece out. The Bank of England did a study. I don't know whether you know this, but the last 700 years, I didn't know it, inflation has averaged 1.08%.
Inflation has averaged 1.0, so effectively 1%.
The last 700 years. So what we're going through right now, which has been somehow led by Ben Bernanke, put in the public's head as some scary, horrible thing that we're near the zero bound and we could dive into deflation. If you take out the 70s and 80s, which is a period a lot of us grew up in, we're actually in more normal times now, not with 5 or 6% inflation rates.
So do you think they should even be shooting for 2% inflation then?
I think the 2% inflation target needs to go. If I was running the Fed, thank God to the world I'm not running the Fed, it would probably not be in my top 10 criteria. The 2% inflation target has sort of become a religion initiated by the professors, and it's this target. There's an interesting story on the front page of the Wall Street Journal today, how Amazon is making the Fed's job more complicated. This belief that 2% is appropriate for all seasons and all times, to me, is pretty absurd. You take the last great innovation period, which is the late 1800s, we had deflation for 10 or 15 years, accompanied by very rapid real growth. In the 50s, I think inflation was 1%, maybe a little lower for a good part of that decade. Fed funds were 4%. We had rapid growth. There was no crisis.
So what you're saying now is that if inflation's running, let's call it 1%, that should be considered normal and fine, and they could still have interest rates up at even 4%?
What I'm really saying that, yes, if you took the Taylor rule, and I'm not a fan of rigidity, a normal interest rate given our economic circumstances would be 4%, interestingly. We're at 1%. In Europe, it would be 2%. They're at -40%. In Sweden, it would be 3.75%. They're at -50%. That doesn't even count the bond buying we're talking.
Yep.
But this is all in the name of this 2% inflation target. And I'm just saying, if you look at the 2% inflation target, there's a rigidity in there that doesn't make any sense for me in terms of all seasons. So let's just take, for example, the Amazon story this morning.
Sure.
All right. Is it pernicious inflation if it's because of innovation and productivity? Or let me give you another example. I did a lot of entitlement talks, as you know, and I kept pointing out that healthcare in the United States is 17% of government costs, and the highest in any other country is 11%. If Amazon and other factors were to push that inflation rate for healthcare down, so we're no longer 17% and we move toward the other countries, is that a bad thing?
Right.
Should we then start doing QE because we're not hitting this mythical target. So maybe in the 70s, when inflation was 9 or 10, a 5% inflation target might be appropriate. Otherwise, you'd be raising rates to 50 or 60. But an innovative period like now, I think -1 might not be a horror show. I don't know. 0
For
might
inflation.
be fine.
So
and other periods, 4 might be fine. It's just, we're in an innovative period, and fixating on this 2% is causing a lot of other consequences.
That's what I was going to ask. So if they're keeping rates in this country, barely above 0, and other countries below 0, what do you think the consequences of all that is?
Well, the consequences are huge because we've distorted market signals and we're causing all sorts of what I would call misallocation of resources.
Like Bitcoin, or is that unrelated?
No, it's not unrelated at all. Bitcoin, art, wine, equities, credit, you name it, everything is one way up, and there are huge distortions taking place, and it's all in the name of this 2% inflation target. And when you get a misallocation of resources, it really hinders growth over the longer term. Let me give you an example. Last week, there was a company called Steinhoff.
That's the company that's the parent of mattress firm in the U.S. now.
Yeah, this is a South African firm. I was lucky enough to be short the stock because someone was kind enough to explain to me that these guys might be crooks. There was fraud at best when you look what was going on. It's a huge roll-up. They buy this mattress company in the U.S. for 100% over where it was trading. They're borrowing money, big roll-up, big credit. And guess why they're able to issue all this debt? Because the ECB is buying it. Of a company that half the street knew was a fraud and is going to go bankrupt. Now, Mario Draghi would tell you, no problem. We're making money overall in our portfolio. The fact that we lost 150, 160 million on these bonds, it comes out in the wash. The point isn't whether the ECB is making money. The point is they are keeping crooks and zombie companies alive. This is exactly what Japan did for 20 years. It hinders long-term growth. Companies like this should not be walking around borrowing money. And that's kind of where we are today. You see what's going on in Bitcoin.
Do you own any cryptocurrencies?
I don't own any. Obviously, as a trader, I should have, but I only trade what I know. What I do know is it takes the same amount of energy to do one Bitcoin transaction that it takes to power 9 homes in the U.S. By 2019, it'll take up half the energy in the entire United States to run the Bitcoin network.
Sounds like the utility companies are a buy.
Yeah. Well, I find it interesting that most of the people in Bitcoin are climate people. They're West Coast people. I don't quite get the connection. We've got this rogue currency that we're all going to support that is destroying the climate in some extent, but whatever.
So you're not going to take a position on whether Bitcoin is going to go up to 100,000 or 1 million or whatever the... I mean, if we're talking about bubbles, it must look to you like some of the greatest we've ever experienced.
I don't know whether it's the greatest we've ever experienced. Look, Bitcoin is like anything else. It's worth what people are willing to pay for it. And right now, people are willing to pay, I haven't looked in the last 5 minutes, so it could have varied 10, but let's say they're willing to pay $17,000. That's what it's worth. The tulips were worth when people were paying that for them. Gold is what it's worth. What I do know about Bitcoin is the concept that it could ever be a medium of exchange has been eliminated because you can't do transactions, particularly retail transactions, with something with this kind of volatility. But if people think Bitcoin is worth $17,000, that's what it's worth today.
Last thing on this before we move on, there are people who want to hold Bitcoin because they're as critical of the Fed and other central banks as you are. So if they agree with your philosophy that the central banks are screwing this up, then what would be a better way to express that than holding something like Bitcoin?
That's an excellent question. I think at some point figure out when this is going to end and then either get out or go short. Because, by the way, when this ends, and it will, I'm talking about this monetary radicalism period we're in, Bitcoin will probably go down with the rest of the stuff.
So are you actively positioned for that now? Because I know you've been talking about these themes. How's it been trading this, given that the market has been going against you time and again.
What is the question exactly?
On the macro front.
Yes.
Let me ask it this way. How has the year been for you? Because you do, the funny thing is, you actually have what looks like the dream portfolio. You've got the FANG stocks, you've got the Chinese platforms, you've got the names that are up 70% in some cases. And while at the same time, of course, having some concerns about the macro climate. So how's the year been?
I would have to say it's probably the worst year I've had relative to the set of opportunities out there I can ever recall. I mean, for me, 1997 was close, but
that was an Asian financial crisis.
Well, that was a pretty good opportunity. I understand why you have this impression, because the day after the election, I was on your network and pretty much was very constructive. You've obviously been looking at the 13F filings. It looks like I'm making a fortune in stocks. I have done very well in stocks. I've really, really mistraded macro. It's going to be, if it was up to macro, I'd have my first down year, but stocks have bailed me out. So,
wow.
Barring a miracle, that's not going to happen. But
you're not up 30%.
I'm not up anywhere near 30%. I'm not up double digits. I'm having, again, relative to the opportunity set, a terrible year. It's going to be my first, barring a miracle, it's going to be my first down year in currencies ever.
And what happened in currencies?
I don't know whether you're a golfer, but I remember the great Seve Ballesteros after he four-putted the 16th at Augusta, and in the media tent they asked him what happened with the four-putt, and he said, I miss, I make. That's how I traded currencies this year, Kelly. I had a lot of misses and a few makes.
I've pointed out repeatedly the fact that the U.S. dollar is so weak. Would that be one example, or are we talking about other things?
No, it was just me over trading and being cold at the wrong time, and since it's been my bread and butter for years, I'd say over allocating exposure there relative to equities. Somebody on your network said a week ago, all you had to do this year was roll out of bed and you're going to be up 20 or 30%. Apparently I got out of the wrong side of bed.
How are you setting up for 2018?
This is really an interesting puzzle because I don't buy the narrative on the TV that this is all about earnings. Yes, earnings have been better the last 6 to 9 months, but they weren't better the last 5 or 6 years. It's been maybe multiple. And if this was all about earnings, your favorite thing, Bitcoin, wine, art, wouldn't all be outperforming the S&P. This is about, in my opinion, central bank radicalism. They're buying at an annual rate $1 trillion a year in bonds in a pretty robust economy. And on top of that, as I'm sure you know, a third of the world has negative interest rates. So this TINA, or there is no alternative, or whatever's happening, this money is obviously going into financial assets. What's interesting about the puzzle they put in front of us is, if you believe the central bank schedules, and if you think the ECB is going to stop this nonsense next September, that $1 trillion annual rate is going to go to minus $600 billion over that period of time.
That's a big swing.
Yeah, the other way to look at it is on average, every trading day, the central banks are buying $3 billion worth of bonds. And whoever sold those bonds to them is getting zero, and a lot of that money is leaking into risk assets. So we have the potential a year from now that that $3 billion a day in buying is going to be $2 billion a day in selling. In addition, if you look at the Fed dots, God knows where they'll be after tomorrow, but let's say you think Fed funds next year are going to end at 2 or 2.25. It's hard to believe that a delta of minus $1.6 trillion rate of change in bond buying versus letting them run off, and that kind of tightening, that financial asset prices will be sustained where they are now. But our business is about timing, and I am very uncertain about when this is going to matter. And if you look at traditional market indicators like breadth and all that kind of stuff, they're all still very positive. And it's not shocking, because today probably the ECB bought $3 billion. So, but in January that goes to $1.5 billion or less, and then in June the net with our shrinkage goes to zero and then it goes negative, probably going to matter.
So are you going to hang on to Facebook, Amazon, Netflix, Alphabet? Do the FANG names, you just ride this out?
I really, really like those names long term, and those 13F filings don't show what I have against them. And it'll be...
What do you mean what you have against them?
Well, they're called shorts.
Are they just hedges, or in other words, are you just hedging your exposure? Are they shorts in other social media companies, or?
I don't really like hedging. To me, if something needs to be hedged, you shouldn't have a position in it. But there's so much disruption going on in our economy and in the global economy. There's plenty of opportunities to find on the other side. I think...
Like IBM, which you've traditionally shorted?
Well, I don't know whether IBM's stock is a short right now, but that's the kind of company which to me has been underinvesting, buying back stock, paying dividends, while their competitors are basically eating their lunch in cloud and in AI and everything else that is competitively mispositioned. Or like retailers, old line retailers, I'm sure you know this, we have 24 square foot per person in the United States of retail space. China has 3, Germany has 2. I would call that being overstored.
So are you shorting sort of a basket of retail names, or? I
have been short retail throughout the year, and depending on the time period, sometimes larger, sometimes smaller, and I would expect that theme to continue.
So you're hanging on to Amazon even after the run that it's been on?
I love Amazon. This company, which everyone keeps quoting the multiple,
right,
is selling for less than 3 times sales. Well, who knows? I haven't checked it in the last few months, but the S&P is selling for over 2 times sales. They're dramatically under earning. I don't think looking at the price earnings ratio is the right move here. You have to look at the long-term earnings power of the company, and they are intentionally under earning. They're investing, and I think Bezos is incredible.
Do you like the Chinese consumer companies for the same reason? Baidu, Tencent, Alibaba, those seem to be emulating Amazon's strategy.
Well, I don't think I'd say they're emulating it. I really like Tencent, and I really like their position. They're in payments. They've got their own version of Netflix. They got their own version of cloud. WeChat is probably the best platform on the entire planet for all of it. And then they have a gaming business. You know, it's funny, if you look at Amazon, AWS is basically funding all the investments they're making in the other areas. With Tencent, their games are funding everything else they're going. So
you own Tencent, right?
Yes. Mm-hmm. Like Amazon, Tencent is intentionally under earning, and it just, the long-term growth looks incredible. I think it's 40 times earnings, and they're going to grow at least 40%, so it's 1 times growth rate. I still like it.
This is a little bit different, but what about Tesla and Elon Musk? Do you see analogies between what he's doing and Amazon and Bezos, or is that actually for you a problematic valuation story? Have you ever owned it?
No, I'll tell you a funny story about Tesla. I had a guy who managed some money for me come in when the stock was $82. And I think I was 62. So I had given myself a Tesla for my 60th birthday. And he had this incredibly effective analysis, like 20 pages of financials about why Tesla was a short. And at the end of this presentation, really well thought out, I said, "Have you ever driven the car?" Mm-hmm. And he said no, and I sent him his redemption notice the next week.
So you didn't short it?
I did not short it, and I don't know why it never occurred to me at the end of that conversation why I didn't buy it. But no, I don't put Tesla in the Amazon category. They have not proved to me that as a financial model and an economic model it's going to work. But no, I don't like to short great products. That's not my deal.
What about Apple in that case?
Apple I don't find nearly as exciting as, say, Amazon, Facebook, or Google. It's a hardware company. I understand they have an app platform, but
You use their products? You consider them great products?
I do think they're great products, but they're probably no better than Samsung's, but they have a great brand. I just think, I don't see the under-earning that I see in these other companies. If anything, they're probably over-earning in terms of the margin they're making. So I don't own that one. I'm also not shorted.
Anything, I know that you've had a position in Workday, I think, maybe trimmed Comcast. We could talk, Citigroup and Chubb, I think, are some of the, anything there that interests you thematically for 2018?
Well, I love Workday because it fits in the new economy we're talking about. And I think Anil Bousra, who runs the company, is just an incredible CEO, co-founder of, obviously, PeopleSoft and Workday. He gets the whole thing in enterprise. The other names, not that interesting to me long term.
One thing I wanted to circle back to, we were talking about earnings, and one of the things people get excited about still is tax reform and the prospect they have for boosting earnings next year and maybe a little bit beyond. And I know you didn't vote for the president. Has he won you over yet? Do you like this tax plan? Do you think it will be good for corporate America and for the American economy?
My answer to that is quite nuanced. On your network the day after the election, I said I was very excited about the prospects for deregulation and tax reform. I thought there was a good chance they could boost the economy. I was particularly excited about the House program, A Better Way. And I thought it was the first program actually I had seen in decades which would address our fundamental problem in the United States, which we overconsume and we underinvest. And literally all they had to do was sign it. But Secretary Mnuchin had other ideas. And to me, it's just been a huge missed opportunity.
Do you think the current tax reform plan is sound?
No. Having said that, there are some things that are helpful in it that go a little bit of the way A Better Way went. First of all, there's expensing. That's obviously pro-investment. Like the Better Way, but again, very muted and carved out for some of their buddies. There's interest deductibility, because I think we got too much debt in this country and we don't have enough equity. And the final thing is you've really broadened the tax base. So a lot of individuals are getting tax cuts.
Do you get a tax cut under the plan?
No, I'll get a 600 basis point increase.
Does the estate tax repeal help you? That must help you.
Is that going to be repealed?
Or the raising the ceiling, I guess. Maybe that won't do too much.
I'm hoping to end up pretty near zero.
Your personal holdings?
So I don't really look at the estate tax. I don't like the repeal of the estate tax. I do like this idea of 10 or 15 million, so somebody's nest egg, but repealing $300 million, I don't get it. The other thing I should have mentioned is moving the tax system to a territorial base, not as good as the border adjustment tax. But
you wanted the border adjustment tax?
I was wildly in favor of the border adjustment tax, and to me it was, again, it was a very elegant solution to the problem we were over-consumer and under-investing. Unfortunately, Mr. Mnuchin and all their lobbying buddies from retail companies, which are probably not even going to be in business in 10 or 15 years, succeeded in killing the thing. It's pretty amazing that...
Would it have hurt Amazon too, though, or no?
I don't really care if it would have hurt Amazon. I don't think of things in those terms. Net, I don't care. I think we need to tax. That was sort of a value-added tax and drag, which is why it kind of got killed. But I really liked it, and it obviously got nixed very early on by a just brutal retail lobby.
So do you think if the tax reform plan passes, and we don't know the final details yet, but what difference do you think it'll make to the stock market and the economy right now?
I don't really think it's going to matter to the stock market. It's already in the stock market. And I think the stock market is basically a function of central bank policy, and any benefits to earning, I think, will be offset by central bank adjusting to that. I would say on the economy, it should have very, very stimulative effect in 18 and some for a few years after that, and longer term, if anything, it's a problem. Let me explain.
Real quickly on 18, you think it'll be very stimulative, which is not what most people think. Is that because of the expensing, or?
It's not only the expensing. Ironically, the expensing is going to be more powerful even than it appears if the tax cut for corporation is delayed a year, because then if you're a corporation,
You have a huge incentive to
you
lower
have
your
a
rate.
bigger expensing under the higher tax rate in 18 than you would have under 19. So I think it supercharges capital spending and investment. My problem with this whole thing is, and again, the House plan was tax reform. It was not net fiscal stimulus. Here we are 8 or 9 years into an economic expansion. We're going to need ammunition desperately down the road, and we're increasing the deficit. Depends on how you score it, $1 trillion to $1.5 trillion, maybe more. So when Bush took over, I think debt to GDP was under 50%.
Wow.
By the end of Obama, the two of them did their damage together. It was 77. This thing takes it to 95. Kelly, if you remember, I spent 2 years of my life going around to colleges talking about entitlement reform and
Which may be next. I mean, they say they want to maybe do welfare reform next year.
I see a picture up there. Maybe I could sell you the Brooklyn Bridge. I see it over there on that picture. It would have been so elegant if they had used the fiscal stimulus in this on the corporate side and on the individual side and offset the $1 trillion or $1.5 trillion stimulus with entitlement reform. We have 11,000 people a day turning 65 for the next 20 years. This is a ticking time bomb that has to be dealt with. We're stealing from our future, and we just aggravated the problem. And to me, we could have used the stimulus and offset it with reform to Medicare and Social Security, and we whiffed.
Last two questions then. Putting that aside, or maybe that being part of it, do you support the president more now than you did back on the campaign trail or, in the past?
Well, I never supported him on the campaign trail. No. I think the tax plan, it is what it is. There's some good things and there's some bad things. I didn't get on all the bad things. I am so offended by the carried interest provision.
The fact that they're keeping it in place, so people
Well, it's outrageous. We have doctors and lawyers in blue states, tax rates going up dramatically, professionals, and you have these multi-billionaires with carve-outs. Now let's be clear. Carried interest, you're making money on somebody else's capital. It's not on your own. If that's not income, I don't know what is. I want to repeat that. You're doing it on other people's capital. First of all, the billionaires lobbying the congressman for this ought to be ashamed of themselves, because we're asking doctors and lawyers and other Americans in blue state to take tax increases so we can fund this kind of nonsense. And as for its economic benefits, half the companies these guys buy, they then strip them and fire people. So the idea that they're increasing employment is absurd, and the politicians listening to them who claim the holier than now we're going to do all this reform and get rid of the loopholes, it's an outrage.
Are you going to get into the business if it continues to look that good that they're just going to totally leave it alone? Carried interest will attract more people than ever after this.
No, I'm not going back into business, partly because I keep missing putts.
Last thing, we've talked about your concerns about the Fed. Would you have felt better if your colleague Kevin Warsh had been tapped to be Fed chair?
Well, I had very mixed emotions. He's an incredible partner. I don't know Jeremy Powell, Jay Powell, I guess, but he seems like a very intelligent, reasoned man. Not a question I'm that comfortable answering when I don't really know the alternative personally.
So you wouldn't necessarily think that Warsh as Fed chair relative to Powell would have made a dramatic difference in the concerns that you have about Fed policy for the next few years?
I don't know about Powell. Worse would have been an incredible Fed chair. He's one of the smartest, most forward-looking people I've ever met. And I think the way they think, going back to our 2% target, needs serious reform, and they need to start using the kind of common sense like Rudy Dornbush used to espouse out of MIT, instead of models with rules and all this stuff. And I think Kevin would have been incredible. I don't know Jay Powell. Maybe he'll be incredible. I don't know the man.
But you think they should raise rates?
I think they should take every opportunity that they can to normalize. As you know, I wanted them to do this 2 or 3 years ago. I think they missed an incredible opportunity. And what I was worried about was corporate debt exploding if they didn't. And as you know, it's gone from $7 trillion to $8.5 trillion. And thanks to them, interest costs have gone down. I want to repeat that. So on $8.5 trillion of debt, we have less interest expense in our corporations than we did on $7 trillion. So to me, you just sneak them in while you can, you normalize. Well, for God's sakes, the world economy is robust. They're now getting another opportunity because of what I would call the short-term stimulus of the plan here. Yes, I would take the opportunity to normalize. Again, I don't like the word tighten, normalize. I think we need a hurdle rate in investment so people don't do stupid things, which they tend to do with free money.
Stan Druckenmiller, thank you so much for your time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.